Okay, let's unpack this. Imagine you're moving to a new city, looking for an apartment.
Right.
How you actually pay that rent the first month, maybe the whole year. It
Yeah.
seems pretty straightforward, doesn't it? A practical detail.
Yeah, just something you got to do.
But what if that simple act, how you pay, actually held some, well, surprisingly deep clues about the whole city's economy, its health, its confidence?
That's exactly what's so compelling here. We tend to focus on the big numbers, GDP, trade figures,
Mm.
the abstract stuff.
Mm-hmm.
But sometimes the really telling signals, they come from the ground level, everyday transactions people make just to live.
Absolutely. And that's really our mission in this deep dive. We're focusing on Dubai, a city everyone knows for its ambition, its fast growth.
Yeah, constant evolution.
But we're not just talking buildings or prices. We're looking very specifically at how people pay their rent, using insights from economist Dr. Pooyan Ghamari.
And his point is fascinating.
Right. He argues the shift in how rent gets paid isn't just about convenience. It's like a live economic indicator.
Revealing what exactly?
Things like Dubai's structural maturity, liquidity in the market, how ready it is for fintech, and just its overall economic adaptability. Rent as more than just housing costs.
It's an unexpected angle, for sure. You don't normally think rent payments and macroeconomics in the same breath.
Exactly. So this isn't just a real estate chat. It's about how global capital, local spending habits, and innovation pressure all kind of balance out.
And you see it right there in how people pay for their home. It's quite something.
So let's maybe step back a bit first. What was a standard way? How did people pay rent in Dubai for years?
Well, for a long time, the established norm was pretty rigid, actually. Rent was mostly paid using post-dated checks.
Post-dated junks.
Yeah, typically you'd write maybe 2, perhaps 4 checks up front for the whole year.
Wow, 2 to 4 checks for a year, so each covering like 6 months or 3 months.
Exactly, 3 to 6 months per check, locked in.
That sounds very locked in. Almost conservative.
It absolutely was. And that system, it really reflected something deeper, a sort of conservatism in the region's whole credit ecosystem.
Stemming from.
It basically came down to a trust gap. Landlords needed that security up front because there weren't really strong financial intermediaries to, easily underwrite the tenant's risk.
So the checks were like a guarantee dated into the future.
Pretty much, yeah.
Yeah.
A data security guarantee.
Okay, but our sources are pointing to a big shift happening now, especially more recently. How is that old rigidity starting to, well, break down?
Well, over the last 5 years or so, and really picked up speed post-COVID, that structure is giving way. We're seeing much more flexible, digitally managed payment models coming in.
Okay, flexible how? What kind of new options are actually appearing for tenants?
You're seeing a definite move towards monthly payments. That's a big one. Often paid directly, easily through credit cards.
Monthly, okay. That sounds more familiar to many people globally.
Right. And then there's the rise of these platforms offering pay rent now, pay later, PRNPL, they call it.
Ah, like financing your rent almost.
Essentially, yeah, spreading the cost over shorter terms. And then you see some niche innovation too, like blockchain for contracts, or even subscription-style co-living setups.
Monthly payments, PRNPL. As you said, for many listeners outside the region, paying rent monthly is just normal. So what's the deeper economic significance of this shift happening in Dubai now?
This is where it gets really interesting, economically speaking. It's basically the market finding a way to monetize what economists call liquidity preference.
Liquidity preference, meaning?
It just means the system is adapting. It's allowing people to keep their cash flow matching their real-time income and outgoings instead of having to lock up big chunks of money in advance.
Okay, that makes sense.
And think about who really benefits from that kind of flexibility.
Right, who are we talking about?
Well, freelancers, for one.
Right.
Remote workers maybe getting paid project by project. Tech startups trying to keep fixed costs low.
People without that traditional steady paycheck necessarily.
Exactly. Or even new expats, digital nomads just arriving. They value lower commitment up front while they're finding their feet.
So it's more than just making payments easier. It's actually catering to the financial reality of a more dynamic workforce,
Yeah.
maybe less traditionally employed.
Precisely. It reflects Dubai making a conscious pivot. It's fostering capital fluidity, designing its economic systems more around the user, the individual, and their actual cash flow needs.
And if landlords are moving away from demanding those big checks up front, that must also mean the whole view on risk in the economy is changing too, right?
Absolutely. That shift, From needing multiple checks to being comfortable with systems handling monthly payments, it signals a really significant recalibration of risk tolerance in Dubai's economy.
Because the old way wasn't just habit.
No, the old way with the big deposits and bulk payments, it was partly inertia, sure, but also a real focus on upfront security because the tools just weren't common for managing tenant risk effectively over time.
And now, presumably, those tools are appearing.
That's the key. That's where fintech steps in big time. You have these intermediaries who are really changing the game.
How so?
They're offering sophisticated services, things like proper credit risk underwriting for tenants, basically figuring out if a tenant can pay reliably, maybe using AI, alternative data, not just relying on upfront cash.
So assessing risk more intelligently.
Yes. And crucially, they can offer landlords upfront rent guarantees. That completely de-risks the monthly payment model for the property owner.
Ah, okay. So the landlord still gets their security, just in a different way.
Exactly. And these fintechs provide slick embedded payment platforms too, simplifying the whole transaction.
So these companies are kind of bridging that old trust gap we talked about, but using technology and data to do it.
Perfectly put. And these innovations, they do more than just reduce the perception of risk. They actively enable new financial structures.
Like what?
Well, they open the door for things like tenant financing, helping renters manage payments. And they allow real estate assets themselves to be structured in ways that are more appealing to big institutional investors. It makes the asset class more investable.
I see.
So if you look at the macro picture, it marks this tangible shift regionally away from an economy obsessed with capital control and demanding security upfront towards one that's embracing credit facilitation. It shows growing confidence in the institutions, confidence in digital finance infrastructure, and yeah, even growing confidence in people's ability to pay their bills, consumer solvency.
That's fascinating. It's almost like the way people choose to pay their rent is becoming a sort of live pulse check for economic sentiment itself.
That's right.
Confidence.
It really is. There's a signal hidden in plain sight. How people choose to structure their rent payments gives you direct insight into their economic outlook, their personal situation. You can almost think of it in tiers.
Peers of payment behavior. Okay, let's break that down. What does paying one way versus another actually tell us about the tenant or maybe the market?
Okay, well, think about someone who still opts for the one-check lease, pays the whole year up front.
Right.
That often signals deep personal job security, very predictable income. They're comfortable locking up quite a bit of capital. Maybe they get a small discount or just prefer the simplicity over month-to-month liquidity.
Makes sense. Stability lets you make that kind of commitment.
Then you have the rapidly growing group choosing monthly payments. This often points to a preference for liquidity, right? Keeping cash flexible.
Who might that be?
Could be someone with variable income, a consultant maybe, or a small business owner, or a startup that needs every dirham of working capital for growth. It's about managing cash flow much more actively.
Day to day, month to month. Got it. And what about those using the rent deferment models, the PRNPL?
That can signal a few things, maybe some income volatility, perhaps for people early in their careers, or scaling a new business.
Or maybe just cash flow timing issues.
Could be. Or it might even be a strategic choice. Using credit leverage deliberately, freeing up their own cash for other things, investments, or expenses.
So if you could actually track the overall movement between these tiers, are more people shifting to monthly? Are one-check deals getting rarer? Is PRNPL use growing or shrinking?
Exactly. You could potentially build a real-time sentiment index from that data.
A sentiment index based on rent payments.
Yeah, a ground-level signal. It tracks things like wage confidence, how secure people feel in their jobs, how easy they think it is to access capital, even the city's overall appetite for entrepreneurial risk.
That's powerful stuff for anyone trying to read the economic tea leaves.
It is. From an analyst or investor's viewpoint, this isn't just anecdotal. It's potentially actionable economic data. It shows how real people are reacting to the wider economy, maybe even before the official stats catch up. It's a very granular insight.
That perspective is incredibly valuable, and it ties into this broader idea the source talks about, housing itself changing in Dubai, moving beyond just, four walls and a roof,
Yeah.
becoming more like a service.
Absolutely. Dubai is really pushing the envelope on this housing as a service idea. Because it attracts such a young, mobile, digitally savvy workforce, housing is morphing, is becoming more modular, more financeable, with layers of services built right in.
The source actually calls this the rent stack. What does that stack include? What's layered on top of just the apartment?
Okay, so the base layer is the physical space, the lease itself, yes.
Sure.
But then, stacked on that, you increasingly find bundled utilities. Your electricity, water, Wi-Fi, sometimes even maintenance or cleaning, all rolled into one payment.
Okay, convenience factor there.
Definitely. Then comes the layer of digital payment tools we talked about, those integrated platforms for cards, digital wallets, maybe even exploring crypto down the line.
Right, the fintech integration. What else is in the stack?
A really critical layer is credit reporting. Your history as a tenant, how reliably you pay your rent, that's starting to be recognized and used as actual valuable credit data.
Oh, interesting. So your rent payment history helps build your credit profile.
Potentially, yes. Then you might have incentive layers, loyalty points, rewards programs tied to your tenancy, maybe even experiments with tokenization where tenants could earn fractional benefits or value.
Wow.
And you're even seeing early signs of mobility integration, maybe packages that bundle your rent with public transport passes or credits for car sharing.
So it's integrating where you live with how you pay, your financial identity, even how you get around the city. That's quite a concept.
That's the vision, yes. This rent stack aims to create a pretty seamless interface between real estate, fintech, urban mobility, and even your digital identity.
And for investors, what does this mean?
For international investors looking at Dubai, this isn't just about buying traditional property anymore. It's a new kind of asset class emerging, one that's more fluid, increasingly based on subscriptions, and deeply integrated with retail finance.
This brings up a really important point. In most economies, housing trends, like prices, are seen as lagging indicators, right? They change after the economy shifts. Is that the case in Dubai?
Well, this is where Dubai might be quite different, and it's a key insight from the source material. Because the population is so mobile, what is it, around 85% expatriate?
Yeah, very high.
And because people's visa status is often directly linked to their residency, their housing, changes in the broader economy, like business cycles kicking up or down, or shifts in employment.
They hit the rental market faster.
Almost immediately, yeah. It affects tenancy turnover, how people choose to rent, very quickly. So unlike many other markets, rental data in Dubai can actually function as a lead indicator.
A lead indicator. That could be incredibly valuable. What specific things in rental behavior would you track to get those early signals?
You'd want to analyze trends in lease lengths. Are people locking in for longer terms, or are they preferring shorter, more flexible leases?
Okay.
You'd watch that preference shift we discuss monthly versus quarterly or annual payments. Is one gaining ground? You definitely track the adoption rates of these new fintech rental products.
Yeah.
Are people using PRNPL more or less? Are card payments becoming dominant?
Right, the uptake of new tech?
And you'd also look at geographic shifts. Are people moving towards newer, maybe more affordable satellite communities, or concentrating back in established prime areas?
And putting those specific patterns together can actually give you some foresight.
That's the idea. By tracking those micro changes in rental behavior, you could start to model early shifts in employment levels, maybe anticipate changes in overall investor sentiment towards the city.
Even track capital flows.
Potentially, yes. Get clues about capital migration, are skilled people and businesses flowing in or out. It really has the potential to turn detailed rent data into a sophisticated macroeconomic early warning system for Dubai.
That completely reframes how you look at a rental market report. It's not just about occupancy rates anymore.
Not at all.
And all this flexibility we've been talking about, the monthly payments, the digital integration, it feels like, that also creates new ways to use rent financially and new opportunities for leverage.
It absolutely does. Once rent stops being just a clunky, infrequent payment and becomes a predictable, structured, often digital cash flow, well, that stream becomes significantly more leveragable.
Leveragable. How should we think about that? Is there an analogy?
The source uses a great one. Think about subscription businesses, software as a service, SaaS companies.
Right.
Their predictable monthly or annual recurring revenue totally changed how they could get financing. Right.
Right.
That predictable income stream could be used as collateral for loans or even packaged and sold as an asset.
Right. Revenue-based financing became a big thing. So applying that same logic to rent payments in Dubai, what could that actually look like on the ground?
Well, you could start seeing things like securitized rent receivables. That's where landlords or big real estate investment trusts, REITs, bundle up the rights to future rent payments.
And sell them off to investors today.
Exactly. Package them as financial instruments. You could also see tokenized rent flows representing future rental income as digital tokens on a blockchain.
Offering what? Faster trading? More liquidity?
Potentially, yeah. Instant liquidity, fractional ownership. In co-living setups, you might even see innovative models like rent as equity.
Rent is equity.
And maybe most importantly for individuals, the development of these tenancy credit passports, letting renters use their good payment history as a form of portable proof of creditworthiness.
Okay, so stepping back. By making rent digital, flexible, predictable, Dubai is effectively building the plumbing, the infrastructure, to turn those regular rent payments.
Into versatile capital tools.
Yeah, tools that can benefit everyone involved, the renters themselves, the developers building the properties, the owners, and the financial investors.
That's the core idea, absolutely. It's about transforming what was a fairly static traditional housing expense into something much more dynamic, a potentially financeable asset class that unlocks new kinds of value in capital mobility.
So let's try and wrap this all up. Thinking about the big picture, what are the main strategic implications here? What does this evolution of rent payment in Dubai really mean? First, maybe for governments like Dubai's.
Well, for the government of Dubai, the message seems pretty clear. Actively encouraging and fostering this kind of digital housing infrastructure, it isn't just about making life easier for tenants or streamlining admin.
It's strategic.
Highly strategic.
Get it.
It's a way to unlock significant private capital investment, potentially improve population stability by making it more flexible and less burdensome for people to live and work there.
And attract talent.
Critically, yes. Attract and retain that high-value, mobile, digitally skilled talent pool that really drives a modern, innovative economy.
And flipping that, what's the takeaway for investors who are looking at Dubai or maybe similar markets?
For investors, Dubai is clearly positioning itself as a kind of global laboratory, a testbed for how real estate itself is evolving, moving beyond just being a physical asset to becoming part of a dynamic, integrated platform economy.
So understanding this evolution is key.
Absolutely. Understanding this shift right down to the details of how people pay rent gives you early access and, frankly, unique insights into one of the world's most dynamic innovation ecosystems. That whole intersection of real estate, fintech, and technology.
This has been, wow, a really incredible deep dive. We started with something that seems so basic, so mundane, how you pay your rent. And we've unpacked layers of economic signals, big structural shifts in the economy, waves of technological innovation, and even glimpses of future financial potential.
It just goes to show, doesn't it? Sometimes the most revealing economic insights aren't buried in the high-level reports. They're embedded in the patterns of everyday life, waiting to be seen.
Exactly. So maybe here's a final thought for you, the listener, to chew on. If this simple act of paying rent in Dubai can tell us so much about its economy, its confidence, its direction, what about other seemingly ordinary transactions?
Yeah, in different cities, different contexts, or different industries entirely.
What other hidden signals about the real underlying economy are out there just waiting for us to decode them simply by looking more closely at the everyday stuff?
What else are we overlooking?